Back to our top story tonight, and it's from the shocking news from Kenya Airways now, and they're talking about high operating costs, the travel advisories that have beset the airline. And KQ CEO Mbuvi Nguze sat down exclusively with our business reporter Adelaide Changole to expound more on where the company is headed after the announcement today.
Kenya Airways has just announced a historic 25.7 billion shilling loss in the full year to April this year. And we're joined by Mbuvi Nguze, the CEO, to explain just what happened this year and what the company is doing to turn around its fortunes. Thank you so much for joining us, Mr. Mbuvi. So you have just been in office for 7 months. How did you feel waking up in the morning knowing you were coming to deliver this result?
Remember that even in November, when we announced our results, it was very clear that we needed to prepare the future by doing certain actions, because we could see the trend in results. I mean, it's not something that was difficult to foresee, because we could see the trend. So when I think about how I woke up today, just like I do, my routine was the same as I do every day. It's only that instead of driving to the airport, I drove to the Intercont Hotel.
Right.
But with a mental preparation around the sentiments around the investors, the analysts, the journalists I'll be meeting today, and how I frame my message for where KQ is and what the potential of KQ is.
Right. What would you say are the biggest issues facing KQ, and what brought about this loss that we are seeing today?
A couple of things, I think. Quality-wise, we've increased capacity in the period because we bought new assets. That capacity has not been matched with the uptake from a turnover point of view. So our turnover from a passenger point of view is more or less flat. We've grown the turnover from other sources, and that has increased. But when I talk passenger turnover, I think the other thing is the quality of passengers on board. When I see our increase from 3.7 million passengers to 4.2 million passengers, but the yield has declined, which speaks to the fact that we are not getting the kind of quality revenue that we would traditionally have gotten. And some of the reasons are clear. You know, when I look at, say, the European flows and the markets where travel advisories are, they normally have a higher quality revenue flow into our kind of markets than others. That has not helped. When I look at the fact that, for example, some of our West African numbers have reduced from August when we suspended our flights, those also have an impact. So some yield impacts there, but also exchange rates in our market have also been playing havoc. When you look at India, South Africa, on the euro, those also have an impact directly on the revenue line. From a cost line, probably not highlighting direct operating costs, because in spite of the increase in capacity, the costs remain broadly in line. Fleet costs, very strong increase, almost doubled. 2 reasons. Clearly, with the new assets that we've brought in, we have, of course, more depreciation and more lease costs because we're in an investing period. The second part of that is the 5.7 billion write-off that we mentioned in the half year in relation to the impairment of the assets that we are actually selling. So that's a storyline around fleet costs.
KQ has a negative equity. Perhaps you can just explain to us what that means.
Negative equity in itself is not wrong. I mean, the point that you've got to satisfy yourself is that you have the ability to pay your creditors and the liabilities that you have in the period ahead as they fall due. Because we've done 2 things. We have funded our program based on the extended debt that we have, short-term debt that we have on our balance sheet. But secondly, we have negotiated the bridge loan that will allow us to prepare ourselves for the longer-term capital structure. When you see negative equity because of some of those adjustments, what it means also is that we need to work on recapitalizing our business.
Mr. Mbuvi, you have announced the financing agreement with Exim Bank that will see you getting a $200 million loan from the bank to finance your operations. Perhaps you can just tell us a little bit about that.
So again, I come back to, you know, when you see something, you plan for it. In November, we said we were looking for a financial advisor. We announced that we got a financial advisor. We were finalizing the agreement. The short-term bridge is really to allow us the bridging time to prepare for the long-term funding. That was always a plan, recognizing that we need cash flow in the period to trade. As we restructure to look at what is the optimal capital structure for the business, both debt, carrying capacity that this business has, and equity. Again, talking to the shareholders. It takes time to do things like that. You have to go through a process, and we needed to buy time. That's why we went for the bridge loan.
Do you feel that KQ is getting full support from its primary shareholders, among them, you know, KLM and the government?
We're engaging with our shareholders on a regular basis. We're having conversations. You saw that the government of Kenya also gave us some short-term debt in the month of June. So it's a very positive engagement. KLM is also engaging with us. So we have the right conversation. Of course, because we are a listed company, we have a lot of shareholders. But today in this conversation, in this short period, we have to really talk to the key shareholders. Then we will engage the other shareholders once we have a wider plan.
Right. Kenya Airways is selling some assets, including some of your 767s and some land in Embakasi. Perhaps you can just tell us how much you're planning to raise and what you plan to do with that money.
The net from all the asset sales, we should be raising somewhere like $100 million. If you take the land and the aircraft that we are selling, and that will go into funding the business. It's also part of the working capital of the business.
Let's look at Project Mawingu, something the Senate has said KQ expanded way too fast than it had capacity to absorb. Perhaps you can just tell us, what is a misstep from the side of KQ?
Mawingu is the project that has helped us to deliver the current fleet expansion that we have actually done. So it envisioned, it was a 10-year plan, and it was envisioned in phases. I think today we can look back and say, was Mawingu right, wasn't it wrong? Mawingu is what has delivered the current fleet expansion that we have done today. So we are now in a competitive position. The environment around us probably has changed, but doesn't change the vision behind the fact that you need to plan ahead.
What is the way forward? How excited are you, and what are you putting in place to ensure that you can actually emerge from this storm?
At the end of the day, the journey of 1,000 miles starts with a step. You know, we cannot always say in a difficult environment that you take an optimistic view always, but you can say you have to do the job that has to be done, and that's my job.